adjusting entries that you need to know about. And Chapter 3 is all about the adjusting process. Well, what you learned about in Chapter 2 was to record normal transactions that happen throughout the month. But there are some transactions or activity that needs to be recorded into the financial statements, but doesn't get recorded because either cash hasn't exchanged hands or some event hasn't happened yet to fully get it into the financial statements. So we have to do what's called an adjusting entry, which is to manually put it in to the financial statements, even though maybe part of the event isn't complete yet. So when you're looking at the financial statements here, I've got an example of a balance sheet and an income statement. I want you to be thinking about the balance sheet as a holding place. So the balance sheet is really a holding place for activity that's happened that doesn't get to be on the income statement yet. So the balance sheet is a holding place, and the income statement is ultimately where we want it to end up. The income statement is important because it shows our activity, or when we've earned revenue, or when we've incurred expenses. And so if we haven't incurred revenue or incurred expenses yet, it doesn't get to be on the income statement. We don't get to tell our shareholders we got this income, or we don't get to tell the bank we have these expenses because it hasn't fully happened yet. And so until those expenses and revenue have been earned and incurred, it's going to hang out in a holding place on the balance sheet. Activity doesn't get to show up on the income statement until it's either earned or incurred according to GAAP's matching concept. So we don't want to be recording revenues without having earned them yet, or expenses without having incurred them yet. So this is extremely important. Revenues are recognized when earned. Expenses are recognized when incurred. And until that point, they hang out on the balance sheet as a holding spot. So one major part of adjusting entries is this whole 2 periods or 2 years that we're working with. So what we do is we may not actually pay for something until 2019, but it's earned or incurred in 2018. So the adjusting process is partly due to, we're trying to, just because we paid cash for it here, we're trying to get it to show up on our income statement here in 2018 rather than 2019 when we actually pay for it. Or when cash might be received in 2019, but we actually earned it in 2018, so we are going to go ahead and adjust in 2018 to recognize it on our income statement in 2018 instead of when we actually received the money in 2019. The opposite can also be true. So let me take away my marks here. And we might actually pay for something in 2018 or receive the cash in 2018, but we don't actually incur the expense until 2019. So we don't get to recognize it on the income statement until 2019, even though we paid for it. And we don't get to recognize it on the income statement in 2018 if we've received the cash because it hasn't been earned yet. So we have to delay it to 2019's income statement. So that's really the whole reason that we're adjusting, is to play with the period in which it ends up on the income statement. So there's 5 main adjusting entries that you'll need to know. First, adjusting entry is prepaid expenses. So prepaid expenses are advance payments of future expenses. So this is a situation where we receive the cash this period, but we don't get to incur the expense until a future period. And so we're going to delay recognizing it on the income statement. So here's an example. Let's say we pay for our insurance in advance. So usually, like car insurance, you might pay every 6 months or every year, or maybe every 3 months. So you're going to pay for your insurance in advance, but you don't actually incur the expense until the month has passed or each month has passed. So if we have a $10,000 premium for 6 months, as soon as we pay it, actually no time has passed. So we don't get to expense it, which means it doesn't end up on the income statement. We have to wait until it's incurred. So let's say this happens on October 1st. So what we do is we pay for the premium, so that's a credit to cash, and we're going to put it in an account called prepaid insurance, or a debit. Now, prepaid insurance and cash are both assets, and they're going to end up on the balance sheet. So nothing on the date that it's paid ends up on the income statement because we haven't incurred anything yet. So then what we do on 12/31, the last day of the year when we're putting together our financial statements, is we decide, all right, how much of our insurance have we incurred and do we get to expense? Well, it looks to me like 3 months have passed. So October, November, and all of December has passed. So we need to decide how much is 3 months worth of insurance. Well, if $10,000 is for 6 months, that means that's $1,667 a month. So for 3 months of insurance, that should be $5,000. So we can go ahead and recognize $5,000 on the income statement. So insurance expense, $5,000. And we're going to remove it from this holding place that's on the balance sheet. So we're going to credit prepaid insurance. Since prepaid insurance is an asset, it's normally a debit. So it's been sitting there as a debit balance of 10. If we want to decrease prepaid insurance, we have to credit it. So this indicates that prepaid insurance is going down. Let's look at how this would affect a T account for prepaid insurance. So what we did on October 1st is we put $10,000 on the balance sheet in this account. Then on 12/31, we took out $5,000 with this credit here. And so now our balance in our prepaid insurance account is $5,000 on the debit side. That's what's left. So that will be recognized next year when 3 more months pass. So that is an example of prepaid insurance, or prepaid expenses. Other examples could be supplies. So we treat supplies like our prepaid account, and we treat rent. If you have rent that you pay in advance, you would treat rent as prepaid until you incur your rent as time passes. The second type of adjusting entry is unearned revenue. So unearned revenue is the advance receipt of future income. So this is an example of we've received the money this year, but we did not earn it yet. So we can't put it on the income statement. So what we do is we put it in a holding place. Here's an example. Received $20,000 for 4 months worth of work. So on the day we received it, let's say they paid us in advance $20,000. So we're going to debit cash because we got the money. But we didn't do the work yet. This is a lot like how an attorney would ask for a retainer. They want 20 grand up front before they do any work. So we're going to put it in an unearned revenue account. This is a new account you haven't seen yet. It's a liability account. So even though it's got the word revenue in it, this is a liability account, and it's normally a credit. Both of these show up on the balance sheet. So we receive the money, but nothing hits the income statement because we haven't earned it yet. So then on the end of the year when we prepare our financial statements, we need to see at least 1 month of that revenue hitting the income statement, because now we've earned it. We've earned 1 of the 4 months. So if 4 months is $20,000, then 1 month is $5,000. So we've earned $5,000. So we're going to take $5,000 out of this account. Since it's a credit balance, we need to remove it with a debit. So we're going to debit unearned revenue. And credit real revenue. Let's call it service revenue. You could also call that fees earned. So here is where we've hit the income statement, finally, for what we have earned. Let's see what remains in that account. If we do a T account for unearned revenue, we put $20,000 in it. We just took $5,000 out at the end of the year, and we still have $15,000 left to earn. And this will be on the income statement next year. This hits the income statement this year. So these first 2 examples, prepaid expenses and unearned revenue, are when the cash has already exchanged hands. Cash has already exchanged hands. And these are called deferrals, when the payment is already made. So those were the first 2 types of adjusting entries. Deferrals. The next type, or 2 types of adjusting entries, are accruals. So accruals are different from deferrals because no cash has exchanged hands yet, and the payment hasn't been made. So the payment's going to get paid next period, but we want to recognize our revenue or expenses in this period to get on the income statement now, before cash has exchanged hands. So the first type of accrual is accrued revenue. And accrued revenue is unrecorded revenue that has been earned, but we haven't gotten paid yet. So let's assume on December 31, we know that we have earned $2,500 for services. But because we didn't get the cash, that $2,500 isn't in our income yet. So we have to put it in a holding place, and we're going to put it in a holding place on the balance sheet called accounts receivable. And we're going to credit service revenue, or fees earned would be okay too, for $2,500. Okay, so here is where we hit the income statement, and we didn't get the cash, so we're putting it in accounts receivable as a holding place. And then later we get paid. Probably next year. So let's say like January 15th. We get paid. So we've already recognized the revenue. We can't recognize it again and hit the income statement again. So we're going to recognize our cash. So our cash will increase with a debit. And now we're going to remove this accounts receivable holding place. It's a debit balance now of $2,500. So to make it go away, we need to credit that account for $2,500. So now it'll be 0. So if you see our T account for accounts receivable, we debited that account on December 31 for $2,500, and then on January 15th, when we got paid, we credited that account. So now it has a 0 balance. And so we use accounts receivable as a holding place on the balance sheet so that we can go ahead and recognize our revenue on the income statement before we get the cash. Okay, the next accrual type of adjusting entry is accrued expenses. That's the 4th type. And this is unrecorded expenses that have been incurred. So we're going to get down to the end of the year and we are going to see that we have expenses we've incurred, but we haven't paid for them yet. And so we want them to end up on the income statement, but we're not going to pay for them until later. So a good example of this might be your cell phone. So you use your cell phone service all month, but then you get a bill and you pay for it later after you've already used the phone. So let's say it's December 31. We go ahead and accrue the services that we have incurred at the end of the year. So let's say telephone expense, $250. And we didn't pay this bill yet. We're going to pay it later. So we got to put it in a holding place. And we're going to call this holding place accounts payable. Accounts payable is a liability and we owe this money. So this is going to be our balance sheet holding place. And telephone expense is how we get our $250 on the income statement before we actually pay the bill. And then later we pay it. Okay, so we pay it later, let's say on January 15th. So there's our cash going out, our credit of $250, and we're going to remove this account payable credit because we paid it, so we want it to be zero. We don't owe it anymore. So to remove a credit balance of $250, we're going to debit accounts payable for $250. So your T account for your accounts payable might look like this. You put $250 in there on December 31 as a holding space. Then after we paid it, we want it to go zero. So on January 15th, we debited that account here. And so now it has a zero balance in accounts payable. The last type of accrual is depreciation. So we're going to spend a whole chapter, chapter 10, on how to calculate depreciation. But in this chapter, you don't need to know how to calculate it. You just need to know what the entry is. So you'll be given the amount of depreciation. So you're just going to go ahead and assume we purchased an asset and we spent either cash on this or we might have even borrowed money. We can't expense the entire purchase all at once. So if we buy a $3 million building, we can't expense $3 million this year and we're going to use it for the next 30 or 50 years. We have to expense it over time. So you don't have to worry about how to calculate the depreciation. Let's just assume our depreciation for this year is $10,000. You just need to know this entry, and it's going to look just like this every time. You're going to debit depreciation expense to get it on the income statement. And you're going to credit an account called accumulated depreciation for $10,000. So what's unique about this account, because this is how we get it on the income statement, is this is a asset, accumulated depreciation, but it holds a credit balance. So an asset is normally a debit, but in the case of accumulated depreciation, it's going to be a credit. So that's these kind of unusual assets we call contra assets. Contra assets complement another asset. So this account, let's say we were depreciating a building, would go right next to this asset on the books that has a debit balance. So the building itself would have the debit balance, and the depreciation of that building will be in an accumulated account called accumulated depreciation, and it'll hold a credit balance. Every year we will record this entry until it's fully expensed in depreciation expense.